What is going on, ladies and gentlemen? Today we are going to be talking to you about the break-even price in options trading. Now, the break-even is really simple, so I don't want you guys to overcomplicate it, but essentially all the break-even is whatever your strike price is on a call plus whatever you paid for the contract. And on a put, it's whatever your strike price is on the put minus what you paid for the contract. Now, that's really all the break-even price is. It's nothing more complicated than that. And you can kind of estimate how much money you're going to make from your break-even price, because after your break-even price, every 50 cents or $1 that the share moves, you're going to make $50 or $100 every time from your break-even. And of course, there's a bunch of other factors that go into that, like theta, but that's just the basics of options, and I don't want you to overcomplicate that. Now, what does the break-even price actually tell us besides how to navigate how much money we're actually going to make and how far we think the stock is actually going to move when we're buying a strike? Let's go into this INTC call, for example, that we're losing on. This option is going to expire worthless because INTC is trading at 59.43 and the contract expires this week on Friday. Unless INTC moves up like a monster, I just don't see this hitting. But essentially, in order to make our money back on this contract, INTC would have to move up to 64.22, and that's the only way we would make no money and lose no money. So when you're buying an options contract, the strike price you say that it's going to is not actually what it needs to go to for you to make money. You actually need to go to your strike price plus whatever you paid. So in this case, on the INTC, the shares would have to go up to 64.22, because on a call, what you're saying is that you have the ability to buy the shares at $64 if the share goes above $64. So when you're buying an options contract, you're buying a coupon that essentially says that you can buy the shares at whatever strike price. So when you buy this coupon, you have to factor in the price you paid for the coupon, because you're getting the shares at this price, but you paid for the coupon. So even if INTC goes up to 64.12, I'm still going to lose $10 on this contract because I paid $22 for it. Now it's the complete opposite with puts. You go to a put, I paid $14 for this put. In order for me to make money, AT&T has to go below $38, because when you're buying a put, you're saying you have the ability to sell the 100 shares at $38. So in order to make money on AT&T, you have to do $38 minus 14. I don't want you to get too confused, because I know that it sounds very confusing, but it's very simple math. So you just need to watch this video a couple times to kind of understand what I'm saying. Just like I said, the only way we're going to make money on this contract is if AT&T goes to 37.86, because 38 minus the cost, when we're buying a put, we're saying that we're going to sell the shares at $38. So we want to buy them at a lower price. But in order to make our money back, or make any money at all, it has to go below 37.86, because we paid $14 for this contract. Now, I feel like the only way that makes sense is if you know how options pricing works, but how you get this $14 is this contract was actually worth 14 cents, but you're paying for 100 shares. So you do 14 cents times 100, that's $14. So that's 14 cents a share. So you have to add the price you're paying for the coupon into the share, or subtract it if it's a put. You can't get that confused. If it's a put, you have to subtract. If it's a call, you have to add. I always get confused on that one still, so don't get worried about it. But once you repeat it over and over again, you're going to know exactly how it works. But it's still just, puts and calls are just interesting because they're literally the complete opposite of each other. So that's why I feel like people overcomplicate them, but they're essentially the same thing. I'm going to repeat it one more time. Don't overcomplicate it. It's literally whatever your strike price is. If it's a call, your strike price plus the price you paid for it. If it's a put, your strike price minus what you paid for it. And when you're buying an option, you're buying the right for 100 shares. When you're doing a call, you're buying a right to buy those 100 shares at this price, at this strike price. When you're buying a put, you're buying the right to sell the 100 shares at this price, at this strike price. So always be sure to factor in your break even, and you will be able to make a lot better picks when you're choosing what contracts you want and deciding how much money you want to make, how much you think a share is actually going to go up. And there's a lot of things you can factor in with break even, and it's really helpful. So I hope this video was of help to you guys. Thank you for watching, and if you have any questions, leave them in the comments below. Leave a like on the video, and I'll see you guys in the next one.